Well, thank you for coming for this presentation of our financial stability review. The main highlights of the FSR are that the financial stability has improved in the euro area since our latest issue of the FSR. This is clearly shown in this first slide, where you have two indicators of systemic risk that we usually publish. One is related to the probability of two or more banking groups going into default in the horizon of 1 year, and that's the blue line in the slide. And as you see, it has come down to levels around 4% only, totally different from what it was at the time of the crisis and also at the time of the liquidity stress in end of 2011 that led to the decision to issue two LTROs. And the other indicator, the red line, is a composite indicator that takes variables from a set of financial markets and takes into consideration also diversification effects, and as you see, is now at the levels of 2007. That includes, of course, equity market, bond market, money market, Forex, and so on. But all that taken together indicates a very low level of systemic risk right now. So this improvement has been going on consistently since last year, since last July, and is really reflected in these indicators. It's important to underline this main message, although, as you will see, and I will underline, there are many challenges and the situation in several respects remains fragile. We highlight in our financial stability review 4 types of risks. And I say risks, not forecasts. These are risks that may or may not materialize, of course, but that's what risk analysis is about. The first one is related to the basically the profitability prospects of the banking sector and the insurance sector in Europe as a result of the weak economic environment, which impacts non-performing loans, and also as a result of an environment of low inflation, consequently low interest rate margins, and all that impacts the profit and loss account of banks. And as you know, even the growth that is now envisaged in our baseline scenario is surrounded by risks to the downside. So the second risk is a possible renewal of stresses in the sovereign debt market, although we don't see signs of that happening, but it's always a risk if some sort of shock could trigger events in this area. There are still vulnerabilities, so there are risks. The third has to do with the possibility of further turbulence in the bond markets. We have had an episode this year after the 22nd of May announcement of tapering by the Fed. We saw a worldwide increase of bond yields, decrease in their price at that time, which was significant, a significant shock, which then abated, as we know, and that may happen again because we have been living through a long period of very low interest rates. So that may happen. It's a risk. And finally, we still point to the risk of bank funding challenges, in particular in stressed countries, although, again, we see that risk as being reduced since our latest issue of the Financial Stability Review. Going through these several risks, you see there how low, in fact, has been the profitability levels of European banks in the past few years, both of the sample that approximates what is called in the regulation about the SSM, the significant banks, the banks that will be directly supervised by the ECB. We now have started in this FSR to use this sample of 90 banks, banking groups, which represent more than 90 banks, that are included in those banks that will be directly supervised. And then we have the sample of large complex banking groups with the same criteria and the same sample as we have used several times in previous issues of the FSR. As I hinted already, these low levels of profitability are related indeed with several components of profit and loss account and impacted by the low level of inflation and consequently the low level of interest rate margins, and that affects the developments of the net interest income. At the same time, we see that the increase of impairment costs, provisions for non-performing loans, have increased, in particular in the large sample of all significant banks, which corresponds to the blue curve on the right, whereas the red curve is the one about the large complex banking groups, where the increase in impairment costs has not been so significant. But we see also on the left-hand chart that there is a huge difference between the level of profits before provision costs and the level of profits after provision costs, the much smaller red bars on that chart. And which means that, in fact, the low levels of profitability have been mostly explained by the increase in provisions, by the impairment costs related with NPLs. And this, as you see, has been aggravated more recently because, indeed, many banks have been increasing their provisions, partly in preparation for the comprehensive assessment that we are now going to conduct. And this is so relevant that if you would compare the return on equity of European banks with American banks, well, the ROE of American banks is higher, but if you exclude provision costs from both sides, then the ROE, excluding provisions, would be higher in European banks. This is significant because it may indicate that banks are now really provisioning for legacy assets and taking care of increasing the robustness of their balance sheets. This is then, or can be, a temporary situation, and the fact that profitability, excluding those costs, is much more normal, I would say, would indicate that in the future the situation of the banks may quickly improve if indeed the costs of NPLs will subside as the recovery will take place. That is perhaps an explanation why we have seen the stock prices of banks increasing significantly in the past months, quite a number of months now, because the stock prices of European banks have increased more than the average of the market since June, and have increased more than the American banks. This is also related, certainly, to the solvency situation of the European banks, because if there is a sign of improvement of the position of the European banks, that is related with their capital evolution. You see on the left-hand chart the increase in capital since 2008 of European banks, and if you take the significant banks since then, the 90 banks of the sample I mentioned, the core Tier 1 capital ratio has improved by 4 percentage points since 2008. And that has been, by the way, the result of real increases in capital. You know that EBA has disclosed recently an analysis of the evolution of capital in the top 20 banks in Europe and in the US. And if one deducts the share buybacks that have been quite significant on the other side of the Atlantic, the net increase of real capital increases in absolute terms in dollars has been much higher in the top 20 European banks. In fact, in net terms, the increase in capital of those 20 top banks in Europe has increased by 289 billion since 2008, whereas the top 20 American banks have increased their capital in net terms by 168 billion. So that also shows on the right chart that the median of capital ratios of European banks is practically equal, if not even slightly above, the international banks. And that is not only capital ratios, because there is the question of risk weights that you may raise, but also the analysis which was provided by FDIC indicates that if we take pure leverage ratios, so equity, tangible equity over tangible assets, again, the situation of European banks comes quite similar to the leverage ratio of the American banks. So on both sort of indicators, that is the situation. So this improvement also is behind, I think, of this improvement in the stock market perception of the European banks. Of course, this improvement is related to many things. Capital increases, actual capital increases, as I referred a moment ago, but also as a result of deleveraging, of reduction of balance sheets in Europe. Deleveraging has been more pronounced in the United States in the years immediately following the crisis, and not so much in Europe. There were decreases in some banks, but increases in others. But since May last year, there has been a very significant deleveraging of balance sheets of European banks. In fact, as we say in the FSR, the total balance sheet of the banks in the euro area have declined by 3.3 trillion euros, 9% of what were total assets before. More or less half of this reduction since May last year to October this year is attributable to the shrinking of the derivatives book, which means that international banks, it's not only European banks, international banks have been shrinking their derivatives book by settling among themselves when derivatives were on the money, and by that way reducing their total assets. That may be related to concerns with the leverage ratio and the forthcoming regulation about the leverage ratio. In the US, it's not forthcoming. It has been already passed. So these improvements in the capital position and also in provisioning of the European banks means that the robustness of balance sheets has improved, and that is part of the improvement of financial stability in the whole area. This question of capital ratios and leverage ratios is interesting to see that both measures may be complementary and are certainly complementary, because we see on the left that one would expect normally that if a bank has a high capital ratio, risk-weighted, should have also a correspondent leverage ratio, which would be also higher as measured as a ratio between equity and assets. But it's not the case. You have there two blue areas where the banks either have high leverage ratios and low capital ratios, or the opposite on the other lower blue area there. So there is not always a correspondence of indication of robustness and solvency provided by the two measures, which makes them then useful as complements. Whereas in the market, you see on the right the variation of price to book value ratios is somewhat explained by the level of capital ratios, the chart to the left on the right, whereas the differences in leverage ratios do not explain anything about the price-to-book value ratios in the market. So the stock market seems to be more sensitive to capital ratios than to leverage ratios. But the two things are relevant, and as I said, in both indicators, right now the European banks fare well in comparison with their global peers. Well, the second risk I mentioned is about a possible renewal of stresses in the sovereign debt markets. And this is because there are still vulnerabilities. You have on the right, for instance, the indicator of the deficits for 2013 and the levels of debt of the euro area sovereigns. And you see still countries that still have to continue to adjust to reduce those indicators. You may be struck by this outlier of Greece with a deficit of 13.5 predicted for this year. You may be aware that's only the result of the fact that the capital increases provided to the Greek banks via the program and the loans by the ESM were counted or are counted by the Eurostat as part of current expenditure and not as an investment, as it was the case in the past. So the capital injections represented 10.6% of GDP in Greece. So the deficit excluding that, the real deficit, I would say, excluding this one-off impact, is around 3% this year and is foreseen to be 2% next year. So the improvement continues in all stressed countries, but there is still some work to do. And this also is highlighted by the fact, the importance of this risk, of what you see on the left-hand chart, which shows the CDS premia of sovereign debt and the CDS premia of bank bonds. The sort of red pinkish cloud that you see there is very close in terms of its inclination to the 45% line that you see there, which indicates a very strong correlation between the two type of premia. Whereas the blue cloud became, and the dark blue is the more recent data, became less and less, more and more separated from that correlation. Then that blue cloud of data points relates to the non-stressed countries in the euro area. So there is no connection between the risk as seen by this market of banks and sovereigns, whereas for stressed countries, the red cloud of data, you still see this very close connection between the two. So this feedback loop between sovereigns and banks has not been broken in the stressed countries at all. That's part of our hopes for the implementation of banking union, that this can be really changed. You see that the debt ratios are still high in several countries. These are the concepts that are used for the excessive deficit procedure and for the Stability Pact. But it is meaningful also to point to the fact that this corresponds to gross debt. But you have on page 30 of the FSR, you have a chart that shows the net debt ratio, meaning that all countries have in their possession securities of different levels of liquidity, but with value. And if you deduct those securities that they have in their possession, then for the euro area as a whole, the gross debt has increased last year. This year is forecasted to increase from 92 to 93.4% of GDP, but the net debt is at the level of 66%, and that is true of all countries. And if one considers the liquidity of some of those security holdings, that is relevant for any exercise about debt sustainability for the future, and puts these ratios in a lower level than the gross ratio. So you have that information in the FSR. But this indicates, nevertheless, that there are still risks and vulnerabilities, and that's why this is pointed as a risk in the FSR. In spite of the fact that, and that has helped to normalize the situation, as it is the case right now, in spite of the fact that countries, the stressed countries, have undertaken a huge adjustment, in particular in what regards their external accounts, which showed at the time of the crisis, in some cases, very big deficits. And now, for 2013, only Greece will remain with a very small deficit, and all the other countries in stress will be already in surplus. And the important point is that this was the result in all those countries, again, with the exception of Greece until this year, as a result of very dynamic growth of exports, which shows that these countries have been able to correct completely the loss of competitiveness that they had in the first years of monetary union, so much so that now, in terms of unit labor costs, they are now with levels in relation to the other countries below the levels they had in '99. So this correction of competitiveness explains the dynamics of exports and the correction of the external deficit, with, at the same time, the fact that now all international projections, and these are the projections, the latest one of the Commission, indicate that all these countries are forecasted to have positive economic growth next year. So they have come from, in some cases, deep recessions to a situation of adjustment and now some growth. So that, of course, offsets part of the vulnerabilities that are still related to the public finance situation. So there is a mixed view, and that's why there is a possibility, a risk, even if it seems low now, right now, that there could be a renewal of stress in the sovereign debt market. The third risk has to do with the possibility of turbulence in the bond markets again. You see on the right what happened between May and June, and July, sorry. Big increases in the yields of different types of bonds. And on the left, you see the type of assets that suffered more or had more losses and gains from that turbulence from May to October. And you see there that, for instance, bonds of European banks had gains, not losses, during that period, accompanying the good performance of equities of banks. And that you see there emerging market bonds, US treasuries, and euro area non-financial corporate bonds were the ones that had more losses, including a little bit of German bonds, but not so much of Italian or Spanish debt. That is an indication of the type of assets that suffered in that turbulence, which was significant because it is estimated that the overall losses, capital losses as a result of those developments, amounted to 10%, which certainly is not negligible. But what is also interesting is to see that try to think about which type of institutions may have had more losses in that episode. We cannot know for sure because we don't have information about the hedging that these institutions may have had, and certainly many of them had some hedging. But just taking the composition of their portfolios, which is known, you see that to the left, on the left-hand chart, you see that the banks, the MFIs, monetary financial institutions, were the ones with the lowest percentage in relation to total assets of the type of assets that had losses in that episode. And that these assets had a bigger weight in the portfolio of institutions like investment banks or insurance and pension funds and so on. You also see there that the total holdings of sovereign debt of euro area countries by the banks amounted only to 5% of their total assets, which is the blue, dark blue bar on the left. And you see on the right-hand chart some disaggregation of those holdings of sovereign debt. And on the right you have, in several countries, the blue component of those bars are the holdings of domestic debt of each of those banking sectors. And you see the highest ones are in Italy and Spain, but at the level of 10 and 9% of total assets of the banks. And you see for the program countries, the countries that are under program of the EU IMF, the level of domestic debt holdings is only 4% and declining, which is shown by the almost invisible green points there, which indicate the growth rate of the evolution of these holdings of domestic debt. So these are the levels, and by the way, these are the levels as measured in relation to the total balance sheet of these banks in Europe. It's not the total assets of the banks when you consider the consolidated accounts and all their assets around the world. Some of these banks have a big part of their balance sheet outside Europe, which means that this percentage will go down when you consider the total balance sheet of the banks, of the banking groups. And that's, in the end, what is relevant for the possible impact on their situation of any negative developments in those securities. So all this is, again, part of the explanation why the appreciation by the market, as seen in the developments of stock prices, has improved in the past few months. Finally, on the last type of risk, the risk of bank funding, in particular in stressed countries, you see on the left that the cost of funding, the composite cost of funding, includes deposits, wholesale market, interbank market, everything, has continuously declined since 2011 in a significant way, and that also the banks have, since, again, the end of 2011, as a result also, of course, of our LTROs, have had negative issuance of different types of bonds, either covered bonds or unsecured bank bonds, which you see on the right-hand chart. Which means that the banks had lower requirements of funding, and also that they had the central bank funding to repay maturing bonds, and so they did not issue the same quantities of bonds that were maturing. And by the way, this negative issuance is true either for banks in stressed countries or in non-stressed countries, as the chart shows. This is the result of several things. Deposits in stressed countries, bank deposits, have increased consistently since the beginning of last year, so easing their liquidity positions. There were the LTROs, but part of them, significant part, have already been repaid. And at the same time, there were two other phenomena that were happening and, in a way, are connected. The first was deleveraging, as I already mentioned, in a big way. So that reduces, of course, the funding needs of the banks and explains this evolution and the fact that there is less stress in this potential risk. And also as a result of disintermediation, which is shown in particular in the left-hand chart. You see the green bars are the bank loans, the flows, the annual flows of bank loans provided to non-financial firms. And the red bars are bond issuance by non-financial corporations. And as you see, since last year, the issuance of bonds has increased. And if you take the whole period, is practically equal to the reduction of bank loans to non-financial corporations. So there is substitution and disintermediation going on, and the capital markets becoming more important to fund the economy. And on the right, you have the evolution of different types of bonds issued by the non-corporations. This explains the deleveraging, the disintermediation explain why the liquidity requirements of banks have declined and why this risk is now less acute or has declined. So, to conclude, and summing up, financial stability has certainly improved in different elements of the financial sector, but still faces, of course, important challenges. What has improved? Well, it's indicated by the fact that systemic risk measures are at the lowest level in many years, that the improvement of banks' capital and liquidity positions has been significant, and that has been recognized by the stock market, and that we have had some receding of financial fragmentation in Europe, although it still remains significant in some segments. So these are typical indicators of the financial sector situation where improvements are quite visible and clear. Of course, as I say, there are still challenges, and the financial economic situation remains fragile. First, because the economic environment is weak, low growth, downside risks, low inflation, low margins. Second, there are risks of turbulence in the bond market. And finally, there remains financial fragmentation in the interbank money markets and in the lending rates or in the credit market to non-financial corporations in stressed countries. These two elements of fragmentation are still significant, showing that there is still significant impairment of transmission of monetary policy. But the progress achieved is important, and what is coming is something that can make a big contribution to continuing this repair of the situation, meaning banking union. And in particular, the fact that we will start to become supervisor next year, and before we will conduct the comprehensive assessment of the balance sheets of the banks in a way that will dispel any remaining doubts about the robustness and the health of the balance sheets of the European banks. That is essential to rebuild trust in the banks and to reduce fragmentation in the sense that cross-border flows can become again more active as a result of this improved trust on the banks themselves after the exercise is conducted. And the ECB, as responsible for that exercise, will do it in a very rigorous and credible way, because in no way we allow the ECB to be put into question in that exercise. It's the reputation of the new SSM that is at stake. We are fully aware of that. And the governance of the comprehensive assessment ensures that the exercise will be credible and that markets can be reassured about the situation of the European banks. Thank you. I'm now at your disposal for questions.
Please wait for the microphone and identify yourselves before your question. Start with Arantxa.
Yes.
You have reduced the interest rate until the low record 0.25%. Do you see some risks?
We have reduced, sorry,
the interest rate for the main financial operations to the record level of 0.25% recently. Do you see some risks for the financial stability of some countries in the Eurozone after this movement?
Well, no economic measure is simple. There are always trade-offs in economics, as we all know. That's part of the basic principles. And certainly the climate of low interest rates has some risks. I would say in particular for the insurance business, because insurance companies have to invest and to get returns in order to cover their potential liabilities. It also affects the net interest margins of banks, yes, but those decisions are taken for other reasons, and every measure has costs and benefits. And we face a situation of inflation going very low, and also we see that output gaps and pressure for growth and possible pressure in the future for inflation is not yet very clear. So we have to be preemptive in that respect, because in what respects the mandate of the ECB as central bank, it's about inflation, And we are now quite far from the objective that we have adopted of having inflation below but close to 2. So those are the reasons, but of course, nothing is for free in economics.
Mr. Constâncio,
yes.
You mentioned Todd Buell from Dow Jones Newswire, it's a Wall Street Journal. You
yeah.
mentioned some indication of stresses at the beginning of your presentation, and as I recall, you said explicitly that we're a long way from where we were when the LTROs were announced about 2
yep.
years ago. Should we interpret from this that the ECB is ruling out or is not right now looking at another LTRO?
You should not draw any conclusions in that respect. What I said is absolutely true. I also underlined for several reasons that the liquidity situation of European banks is now much better than it was some time ago, and certainly much, much better than what it was in late 2011. So there is no comparison in that respect. That is absolutely true. Yeah. And you should also consider that we have taken the decision to extend the assured period of keeping the regime of fixed rate full allotment until July 2015. It goes beyond the maturity of the existing LTROs, which, by the way, it's also important to underline. When people talk about those LTROs, they talk about 1 trillion, the two. But the net increase of liquidity provision was not 1 trillion, it was 500 billion, because banks reduced other forms of taking liquidity from us at that time. So the net increase was 500. And by now they have repaid 72% of those 500. So that's the situation, which, by the way, is another indication that the liquidity situation of the banks is much easier than what it was.
Mark?
Yeah.
Mark Schröers with Börsen-Zeitung.
Yes.
You mentioned that the low interest rate reduces the net interest income. This is something especially German banks have complained about in recent days. But on the other hand, you're saying, the ECB is saying that low interest rate reduces also the funding cost of banks. So all in all, would you say that the advantages of this low interest rate policy still outweighs the disadvantages? Mm-hmm. And the second question is on negative interest rates. This is something that is under discussion. Just from a theoretical point of view, how would negative interest rates influence the financial system and financial stability? Thank you.
Yeah. Well, on the first question, the main difference on the impact on the banks is related to the fact that some countries fixed interest rates prevail on the credit side given by the banks, whereas in some other countries there is indexation. Credit rates are indexed, say, to Euribor, either 6 months or in some cases 12 months. This means that the impact of any change in the interest rates in the direction of reduction is different in the two types of countries and for the banks, because it depends also on the maturity of the loans. But if the deposits rotate and are repriced more frequently, and the rates for the loans are fixed, when we reduce rates, there is this sort of compensation that you just referred, because over a few months, the net interest margin can increase as a result of the funding cost going down and the rate of loans being the same. So German banks can have that offset effect at this particular moment. It's absolutely true. Whereas if the move was in the opposite direction, an increase, that would be the opposite case. The cost of funding would go up before the cost of the rates collected on loans could increase. But the countries where credit is indexed to market rates, it's the opposite. So it's true that your assumption and your question about the German banks, a country where fixed rates really prevail and are more significant, there is this offset effect. On the other question, well, as you know very well, no decision has been taken. We have announced many months ago that from a pure technical point of view, I mean, systems and so on are ready to do it, but certainly no decision about that, because it's certainly open to measures that are certainly unprecedented. They have been tried. Briefly in Sweden and then in Denmark. It's different, nevertheless, to consider this for a big economic area like the euro area. Only, I think, in extreme situations that measure could be really considered.
Next question. If you don't have any more questions. Oh.
Yeah, there is.
Jean-Philippe Lacour from Les Echos.
Yeah.
Once again, what lessons do you draw from this report with regard of the campaign of assessment of bank assets and then the stress tests, since there are some very major points not solved at this time regarding how to deal with the bulk of sovereign bonds, and it seems that there are some expertise to this topic, but that must be reviewed, like you know what I mentioned.
Yeah.
So what could be the point where ECB could say where the line goes?
Could say? Sorry?
Sorry, what are the rules
Yeah.
for this test?
Well, there are two things there implicit in your question. The first one is about risk weights of sovereigns. That we cannot change because we are not regulators. This is decided in Basel by the Basel Committee. It's decided in CRD4 as the translation for Europe of Basel III. So a supervisor, like we will be, cannot change the regulations. That's for other bodies to do. So on our own, in the AQR itself, meaning the asset quality review, we apply CRD4 and the rules of CRD4. Now, a different thing is the stress test, where we may contemplate some shocks that can affect also those assets. But that's a different thing. So I understood that the main focus of your question was about the first point. On the first point, we apply CRD4 for the asset quality review, and we cannot change the regulation.
Any further question? No? Thank you very much for coming.
Okay, thank you very much.
Have a good afternoon.